Hi, it's Eng here. How do you withdraw the monies from your own companies? You can't just take the money from your proprietary limited company and treat it as your own. What I mean is that you can't just treat the bank account of the company as your own and you just withdraw the money as you want. You have to do it in a certain way to comply with the law. Today, I just want to share with you there is 4 ways that you can withdraw the money from your company. What is the best way to withdraw money from your own company? There is 4 ways that you can withdraw the money from your company. So the first way is drawing out the salary and wages or director's fee. The second way is the company can pay you a frank dividend. The third way is to get a reimbursement or loan repayment from the company. Fourth way is you can loan from the company. So the first way is to get paid as a salary and wages. You just like a normal employee. So your company is your employer. When they pay you the wages, they needs to withhold the pay as you go withholding tax from your pay and then pay that to the tax office. If you're receiving as a wages, then the company needs to pay you 10.5% superannuation guarantee contribution. The company is also subject to paying the work-com insurance. In some cases might be up for payroll tax. So there's good and bad of paying wages to yourself as a director. The gross wages or the director's fee that the company pay you, it's a tax deduction for the company. It's just like a normal expense. The gross wages will declare in your personal tax return. You need to pay tax for it. Because the company already pay the pay as you go withholding tax for you, then you can claim that credit back. So at the end of the year, the company withhold the tax more than what you're supposed to pay for the tax, then you're going to get some tax refund. If company withhold the tax and then you have other income under your personal tax return, then the tax payable is more than the pay as you go withholding, then you're going to end up paying tax back to the tax office. The second way is for the company to pay the frank dividends to you as a shareholder. When the company pay you the frank dividend, that money, the company already paid tax for it, also got the franking credit attached to it. For example, if you're the shareholder and you receive the frank dividend from the company of 50,000, we're working out that the franking credit on that is 16,667. So in your personal tax return, you have to declare the gross amount, which is 66,667. The tax payable is 11,966. Because that amount's already paid tax by the company, you get this franking credit, and the franking credit amount is 16,667. That means you will get a tax refund from the tax office of $4,701. This is not a bad strategy to get a pay frank dividend from the company. The third way is a very common way is as a director, as an owner, sometimes we pay for business expense from our credit cards or from cash. You can get that reimbursement from the company. The amount that reimbursed back to you is not taxed. Or maybe when you start up the company, you need to put a lot of money as your capital in the company. You have the working capital. You loan the money to the company. So later on when the company have the money, have the cash flow, the company can loan repayment back to you. That's not taxable. If the director has paid for business expense on behalf of the company or loan to the company, then the company is able to repay that back to the director. The director do not pay any tax on this loan repayment or reimbursement. Now, the fourth way is the company loan the money to you. During the year, you might withdraw money from the company and to pay for your personal stuff. We can treat this money company loan to you, but you have to do it in a certain way that complies with the law, which is what we call Division 7A law. You owe the money back to the company. To be complies with the law, you need to have a complying loan agreement with the company. You have to pay principal and interest back to the company. It depending on what you're using that money for, like when you borrow the money from the company. If you borrow the money from the company is to purchase an investment property or investment in shares, then the interest that you pay back to the company, you can claim that interest expense in your personal tax return as a tax deduction. But if you borrow the money just to pay for your own personal expense, then the interest that you pay back to the company is not tax deductible. From the company's point of view, it doesn't matter what the purpose of you borrowing money. If you pay the interest back to the company need to declare that interest received as an income for the company and they have to pay tax on it. Before you launching your company tax return, we have to work it out how much money that you borrow from the company. So sometimes it's better that we declare some dividends to you to offset against that loan because you don't want to pay that extra tax. So basically the Division 7A loan, it's happening is when you borrow the money from the company and you haven't paid that back, But if you repay that money back to the company before you lodge your company tax return, which is the due date normally is like 15th of May 2023, which is the following year, as long as you repay the loan back before you lodging your company tax return, then there's no Division 7A loan. The company can also pay you salary and wages or director's fee or declare dividends to offset against the money that you took out from the company. So depending on the circumstances, we really need to sit down and work it out because everyone is different. What is a complying loan agreement? You need to meet all these requirements. We assist our clients to arrange with the lawyers to prepare this loan agreement. This Division 7A loan agreement need to identify the name of the lender and the borrower, terms and conditions of the loan. You need to specify what is the amount of the loan, the requirement to repay the loan. The interest rate is determined by the tax office. For this year, 2022 and 23, it's 4.77%. Every year is changing. We need to use that rate to calculate the Division 7A principal and interest loan repayment for you. And then we will tell you that you need to meet that minimum loan repayment. Because if you don't, then the amount that you draw out from the company, the tax office is going to treat that amount as an unfranked dividend. Then that is not a good result, because what it means is the unfranked dividend, the amount that you withdraw from the company, is going to treat it as your income under your personal tax return, and you're going to pay very high tax on that. We don't want that to happen. We need to make sure you have this loan agreement in place before we launching the company tax return. The term of the loan, there's two types of loan. There's this unsecured and the secured loan. And this loan agreement needs to be signed and dated before you launching your income tax return. There's two types of the loan. One is unsecured loan. Is you need to repay that loan within 7 years. So it's very important that you comply with the law. To repay back the loan within 7 years require a lot of cash flow from you to have the money to pay back the company. Another option is that you can extend the term of the loan. The company need to secure over your property as a secured loan. If you can have a secured loan, then the loan repayment is 25 years. If you don't rectify the situation before you launching the company tax return, then the ATO will deem the loan amount as an unfranked dividend to you. That means that you have to declare that amount as your income in your personal tax return, and you will get taxed on the top marginal rate of 45%, plus the Medicare levy would be up to 47%. Now, this is not a good tax outcome. Now, I just want to share some example of the power of the tax planning. I have done this plan. It's just an example. Please do not act on this until you talk to your accountant, your tax advisor, because this is just an example. Let's say that your company is making net profit of $200,000, and this is before paying you wages or paying you dividends. And if it's a straight $200,000, you're making a net profit, the tax rate now for the company is 25%. That means that the company needs to pay the tax is $50,000. Scenario 2, let's say the company declared to pay frank dividends to yourself and your wife of $100,000 each, which is all the fully franked dividend. The tax can get reduced to $47,534, and that's a saving of $2,466. Scenario 3, the company decide to pay you wages of $75,000 each, $75,000 to you and $75,000 to your wife. Instead of a $200,000 net profit for the company can claim the wages, which is total of $150,000 as an expense. The net profit of the company is $50,000. For $50,000 times by 25%, the tax payable is $12,500, and for the individual tax payable, it's $14,842 each. So if you add up these three, the total tax that have to pay $42,184, which is, you can compare to the scenario 1, a tax saving of $7,816. And let's say you say, oh no, I don't want to pay myself wages, but I want to pay 50% of the dividend back to me as a shareholder and my wife. If that's the case, we let the company pay the tax. After the company pays the tax, we will get the franking credit. We put the franking credit and the dividends in our personal tax return. We can get a credit on that, which is I demonstrate in the last slide for you, that each of you can get a tax refund from the tax office of $4,701, which is basically you get some tax back from the company tax that you pay to the tax office. It's like one pocket out, one pocket in. Total tax on that is become $40,598. So that's even more savings. The tax saving using this strategy would be $9,402. This is a really good outcome as well. Let's say you don't pay yourself dividend again, but you just want to pay yourself $50,000 in wages and your wife $50,000. Then the tax on that when you add it up, is 36,934, which is 13,066 rather than from the first scenario. As you can see, it depending on your circumstances and your goals and the outcome that you like to achieve. And that's why we always ask, what's your plan for the future? What are you going to do with your business? And they're all depending on your circumstances. This is just an example. We can work out 5, 10 scenario until we work out the best outcome for you. In this case, we would want to choose the lower tax as possible, right? Because we don't want to pay more tax than what we should to the tax office. If you compare to the first one, you are saving of $13,066, which is a lot of money. And this is all your hard-earned money. And that's why I say it's very important that you need to sit down with your accountant. You can come to consult with us. It's all to do with the strategies and the structures that you set up and so forth. Should you need any help, please feel free to contact us, and you can log into our website, book an appointment to talk to us, or you can call us directly, and then we are more than happy to assist you. So thank you for watching my video. Have a nice day and stay safe.